We are live. So, welcome everybody. This is the last video recording for the DCF walkthrough series that we have been doing for the past 2 weeks or so. This video is going to be about how to do a full comparables analysis, a full trading comps analysis. And I'm very excited to show you how to do this because it's very different from the intrinsic valuation techniques that we have taught you over the past 4 sessions. So the first 2 were live, we did those over Zoom, and then the last 2 YouTube recordings about finishing the DCF model. But today we talk about comps. We're going to be completely removing ourselves from common valuation theory because this is not intrinsic valuation. This is all market-based analysis, and it's going to be very fun. So let me give you a little preview of what our full comps analysis will look like. It'll look something like this. I know, and it'll culminate in a nice, sexy looking graph like that. Do not worry, all of that seems like a lot of work. It's actually not. It actually is mostly just copying and pasting, if you can believe me. But we're going to walk through it together. I'm not sure how long it's going to take, but we're going to do a full comps analysis for Coca-Cola and its comps. So this is optional for your stock pitch. You do not need to do a full-length comps analysis. You don't need to go to the extent that I will go into in this video. If you want to keep it simple, we've talked about some commonly used valuation multiples that you can compare your target to its comps and pick out the ones that seem the most interesting and then talk about them. But if you really want to go above and beyond, and especially for investment banking style Excel workbooks and Excel evaluations, you will need to do a full comps analysis. Now, I will say that what we'll do today is probably not going to be as in-depth as you would go into if you were actually working at an investment bank, because there are certain shortcuts that we'll take today that we wouldn't really be able to do at work. But it's okay to do them today because this is a little bit more simplified, but it still has the depth of, it still has the quantity, the volume of ratios, and the quality of the analysis is not going to really improve significantly with the depth that investment bankers go into. Don't worry about that. I'll get into all of that in a second. But first, let me recap where we are. So we finished, at the end of the last YouTube recording, we finished the discounted cash flow valuation model for Coca-Cola. We projected stage 1 free cash flows. I've talked about this before. We projected stage 1 free cash flows. Then I spent a whole video talking about how to calculate WACC, how to calculate beta, and calculating the final WACC. Then we went into discounting the stage 1 cash flows back to the present. And then in the most recent recording, we calculated terminal value using both the Gordon growth model and the multiples method. We calculate total enterprise value by adding the present value of the terminal value to the present value of the stage 1 cash flows to find our total enterprise value. And from that TEV, we subtracted Coca-Cola's net debt to find its implied equity value, and then we divided by the shares outstanding to find Coca-Cola's implied share price. And we found that it's somewhat overvalued right now. But again, there's a lot of flaws with our analysis because for our free cash flow schedule, we were very lax with the assumptions. I sort of just made these numbers up and I didn't really put any more thought behind it other than to show you an example of how you would go about estimating these revenue growth projections for the future. So these really are just made up numbers. Maybe they're too high, maybe they're too low and the company's actually a buy, because I'm pretty sure Coca-Cola traded up today. So investors clearly see something. I doubt all investors did a full DCF model, but that's besides the point. So there are definitely problems with the model because we didn't go full in depth. We were just filling out numbers to show how do these interactions, if you fill out the cells, how do those interactions come together to create a full intrinsic valuation, right? And then at the end, we did a very nice sensitivity analysis showing what would the share price be. Actually, what I would also recommend is that you do a similar sensitivity analysis with percent upside and downside, and not just your implied share price. But really, this is all you need. Showing how does our implied share price change if we change two key assumptions in our model. The first being the long-term growth rate, the second being the WACC, or the EV to EBITDA exit multiple versus our WACC. And this is what we got. So now we switch over to away from intrinsic valuation and we do comps. So what is the idea behind a comps analysis, right? So if you all remember, when we discussed this during lectures, an intrinsic valuation, I'll just write down some notes. An intrinsic valuation is all using your assumptions. It is a bottom-up model, essentially, where you dive deep into the company's financials, you project its future cash flows, and then you discount those cash flows back to the present at an appropriate discount rate. That gives you the company's enterprise value. You subtract financials to get it into equity value, and you divide by shares outstanding to get it into a share price. So what is the rationale behind comps analysis? So let me write down some notes. Well, comps analysis shows what sort of the theory of comps analysis is that a company should roughly be trading around where its peers are trading. So the essence of a comps analysis is if you have a target company, you find companies that are similar to that company and you calculate valuation ratios for those comparable companies, and you apply certain financial metrics of your target to those valuation ratios, and that should give you an approximation of where your company should be trading if the market is pricing or is valuing those comparable companies accurately. That was just a super high level overview. We'll get more into the details right now. So what are the steps of a comps analysis? So we'll talk about that first. The first step is you need to ID your comps for your target. Target. And you can do that in multiple ways. So the common ways to do that is there are a few factors that you place to find your comps. The first major factor is industry. You want to find comparable companies for any company. Has to be in the same industry or subsector or sub-industry if it's a very niche industry. For Coca-Cola, that seems to be a very broad definition. It's food and beverages, right? That's pretty much what Coca-Cola does. Another important restricting factor is geography. So you ideally want companies that operate in the same markets that are serving the same total addressable market, so that they're all on an even playing field in terms of who are they actually selling to. And the last one is some metric of size. This usually comes in the form of comparing market capitalizations or net incomes or revenues. You want companies to be roughly the same size because investors will price differently sized companies differently. Now we're going to stretch that last restriction a little bit because Coca-Cola, in case you're unaware, is one of the largest companies in the world and is by far one of the largest companies in the food and beverage industry. So finding comparable companies with roughly the same size of Coca-Cola is an incredibly challenging task. Which ones come to mind? Pepsi and who else, right? So we might have to de-emphasize that size factor, but we are only encountering that problem because we're dealing with an industry behemoth. If you are not, then it is more likely that you will find a good set of comps for your company that are all roughly the same size, assuming you're in a properly saturated industry. If you're thinking about super advanced AI companies, there might not be as many of those. But for more well-established industries, say like power and utilities, there's lots of those companies, and there's lots of different sizes of those companies. So it's a little bit easier to do a comps analysis. It's all situation-based, so don't worry if you can't find perfect comps. There is no perfect comp. Don't worry if you can't even find good comps, but it's good to do a comps analysis. The primary purpose of a comps analysis is to serve as a sanity check against your DCF model to show, okay, we can price this company one of two ways. We can look at how the market is pricing. We can do our own fundamental analysis of the company, and we can come up with our own range of possible values. And then we can look at how is the market pricing similar companies. And that will either back or it will go against our fundamental valuation. And depending on the comps analysis, you can you can make adjustments to your DCF because those are much more assumption heavy. And usually you can come to some sort of agreement because the whole purpose of valuation is to make some kind of argument, right? Now, comps analysis can get pretty dirty. Because there's no perfect comp. There's a whole range of values. Comps analysis can give you implied share prices that can be wildly volatile, but it's all part of the process, and so can DCFs. So this is all to say that valuation is a very, very imperfect. It's a very imperfect exercise, but as my finance professor often says, it is better to have a bad estimate than no estimate at all. So we are going to trudge ahead with that mentality in mind. So the first step in a comps analysis is to ID your comps. What's the second step? So once you've ID'd your comps, now you can pull operating statistics about the comps, about the comp companies, the comp firms, I'll call it that. So what are some common valuation ratios used? Well, you have enterprise value based ratios, so EV divided by some metric, or you have equity value based multiples, so equity value divided by something. Well, what can you actually divide by EV? Well, so what is the difference between enterprise value and equity value? The enterprise value is the value of the firm that is available to all investors. Equity value is the value of the firm available only to equity investors. So in keeping with that theme, any denominator for an enterprise value based multiple has to be available to all investors. So what does that include? Well, common ratios include EV to revenue, because revenue is at the top of the income statement, and any revenue that the firm generates can then be distributed either to equity holders or to debt holders. Another common one is EV to EBITDA. This is a very commonly used one. EBITDA is a good proxy for cash, and EBITDA is also above the tax. It's above the interest income line, interest expense line. So it is also available to all holders of the business, all capital providers of the business, both equity and debt. And then there's EV to EBIT, so EV to operating income. That is a commonly used one. This is also called EV to sales sometimes. Now, anything below EBIT is not available to all investors, because what happens after operating income? Well, you subtract out interest expenses, and then you apply taxes to pre-tax income, and then you are left with net income, right? So net income is only available to equity holders. Why? Because cash was already paid out to debt holders in the form of interest income. So on the income statement, it really is only, net income is only available to equity holders, which is why for equity value, the thing that you divide by is net income. Now, this is also called price to earnings, because if you divide equity value by the total shares outstanding of a business, that gives you its share price. If you divide a company's net income by the total shares outstanding, that will get you to earnings per share. The per share price of a company divided by its earnings per share is the same thing as equity value divided by net income. But it's a lot easier to say price to earnings, or PE, P2E or PE, than it is to say equity value by net income. Also, you can't use EV because EV implicitly implies that you are talking about enterprise value and not equity value. So although the ratio that we're going to be using is equity value divided by net income, we're going to be calling it price to earnings. Now, these four, the three enterprise value ratios and price to earnings, are four of the most commonly used ratios that you will see in any kind of comps analysis. Now, to be totally honest, the best ratio that you can use is EV to unlevered free cash flow and equity value divided by levered free cash flow. Why? Because the most important financial metric of any valuation is a company's ability to generate cash. A company's value is derived from its ability to generate cash flows, and the present value of its future cash flows is the value of that company. So why don't we just use EV to unlevered free cash flows, because unlevered free cash flows are available to all capital providers of the business? Or why don't we do equity value divided by levered free cash flows? Levered free cash flows are only available to equity holders. So why don't we do EV to UFCF, or equity value to levered free cash flows, or free cash flow to equity? Well, the reason is that in order to get from net income or NOPAT to unlevered free cash flows, or NOPAT or net income to levered free cash flows, that is a pretty difficult task because you are having to make a lot of assumptions about the company's cash flow generation moving forward. So what does that mean? Not only will you have to get this information, well, because you do generally calculate UFCF for your target company, but if you're doing it for a whole list of comps, that can be difficult because those comps have different working capital requirements. They may have different depreciation expenses. They might have a whole plan for capital expenditures. They might have some might have mandatory debt repayments that you know of. Some might have no debt at all, and some might have very vague debt requirements in order to calculate levered free cash flow. That space from net income, the bottom line of an income statement, to the actual cash that a company generates, it's hard to calculate. So as a proxy, you use revenue or EBITDA or EBIT or price to earning or net income, because that is information that is readily available on the income statement. Remember that unlevered free cash flow is not a financial metric that is reported in a company's financial accounting statements, because free cash flow is not an accounting metric. It's a finance metric, which is why we need to make adjustments to calculate that. But it's not an accounting metric. So this presents complications. So when you pull operating statistics about your comparable firms, what operating statistics do you need? Well, you need their equity value. You need their equity value. Actually, let me go ahead and delete some of my side notes here and then keep working on these notes. So you need equity value, you need enterprise value, and then you need current and future pro forma financials. So you need historical revenues, historical and projected revenue, EBITDA, EBIT, and net income. So why use historical and projected? Because the company's current value is a mix between how the company has performed historically and how investors perceive that the company is going to perform in the future. We're talking about, this is a market valuation. For the market, a market's pricing of a company depends on both its past and future performance or future expected performance. While for an intrinsic valuation, all that matters is the company's future performance because it generates cash flows in the future. So in keeping with that theme of sticking to how would the market value it, you also need to, there's no one metric that you can use. So you end up using a lot of them, which is why we use all of revenue, EBITDA, EBIT, and net income, and you use historical and future projected revenue, EBITDA, EBIT, and net income. Because those can be easily, well, not easily, but those numbers are easily available using equity research reports. Let me just quickly, okay. So now, once you've pulled operating statistics, then what's the next step? Well, here you can actually calculate valuation ratios for each company. Valuation ratios for each company. So you do that by taking your enterprise value and dividing it by revenue, EBITDA, and EBIT, and then you take equity value and you divide it by net income. Once you calculate valuation ratios, then you will pull a range of ratios to apply to your target firm. So this commonly happens if you have a lot of comps. A normal comp set is anywhere between 5 and 15 comparable companies. I believe we're using 7. So if you have a lot, then what you would want to do is you would want to use the min, the median, the max, and then the 25th and 75th percentiles for ratios so that you can get a whole range of market valuations, because that is the purpose of both a DCF and a comps analysis. It is to provide a range of possible values that your company could be valued at. So now, once you calculate valuation ratios for all of the companies, now you only pull a select few. And once you've pulled a range of ratios, then you apply apply relevant target metric to ratios. And once you apply relevant target metrics, so for an EV to EBITDA multiple, you would multiply your target's EBITDA to get an approximation for enterprise value. Or you could take the PE ratio, the industry average PE ratio, and then multiply your company's net income, to get an approximation for its equity value. Then what you do is you convert implied EV to implied equity value, and then the last step is calculate range of implied share prices. So this is an intermediate step because if for all enterprise value multiples you are calculating the firm's implied enterprise value, not its implied equity value, so you need to subtract net debt, and then you get its implied equity value. And then this last step is dividing all of your ratios by the shares outstanding of the firm, and that will get you your range of implied share prices. And I suppose the final step is you create a football field chart showing list and range of valuations, or list and range of implied share prices, but we can stick with that for now. So we're going to do all of this. So let's begin. So the first thing that we need to do is we need to get comps data. But let's first establish what that comps data is going to be, okay? So let me actually be a little bit semantic here and show you some formatting. So Alt HHM gets you to cell color, Control Tab to go over to custom, and then Tab to get down to red to the RGB values. And I like to go with 37 tab 77 tab 130. So 37 for the red, 77 for the green, 130 for the blue. This is the color of blue that I like to use in case you are not familiar. the color of blue I like to use. And then make sure that Alt HFC will change text color. Make sure that your cell color is, or your text color is white so they can read that. And I will bold that. So that is now showing as bold. So this is sort of our header cell. So let's build out our header. So what are we going to use? We're going to generate operating statistics. Okay. So Control D to move that down. And then here we're going to get our comparable companies. Okay. So now here, and then, so the first thing that we're going to get is we are going to get capitalization information. So what is the equity value? And then what is the enterprise value? And then here we will get revenues. So we're going to get historical. We're going to get 1 year for the future, which is technically the present year, so 2023. So projected for 2023, also known as fiscal year 23. And then fiscal year 24. We're going to get that for revenue. And if you want to center across, you can go to Control 1. That will land you on the number tab. Control tab to get over to font. Option U to highlight the underline, and then single accounting. Okay. And then of course Control 1, and then you can do Control Shift tab or Control left. And you can go to Alt U or tab, and then for horizontal text alignment, go to center across selection. Boom. Doesn't that look a lot nicer? And we're going to be getting revenue. We're going to be getting EBITDA. We need EBIT or operating income, and we need net income. So we are going to be pulling 1, 2, and then 3 times 4. So we're going to be pulling 14 values total. So let's do that. So I'm going to Control C and then Alt ES T to copy formatting. So let's do that. Here I will say equity and then value so that it looks a little bit nicer, and then enterprise and then value, and then move this over. I'm going to use my shortcuts, and then we're going to do the same over here. So Control C, Alt EST. Oh, that only works here. Never mind. So Control C, Alt EST, Alt EST, and Alt EST. Great. Now we're just building out our headers right here. So this is going to be our capitalization statistics, equity and enterprise value, and let's just center these. So Alt HAC. There we go. And let's center these two. Okay, equity and enterprise value. So now let's go and get our comps data. So we're going to need equity value and enterprise value for each of these. Yeah, so we need equity and enterprise value for each of these, and then we can go get our historical, also known as LTM or last 12 months. Projected year for 23 and projected year for 24 for revenue, EBITDA, EBIT, net income. So the question is, where do you actually go and get this data? Well, luckily if you have FactSet, they'll do it for you. So if you have FactSet, this is probably what you'll see when you open up FactSet. So go into the search bar, type in Coca-Cola or KO, snapshot, and this comps tab in overview, this comps tab is beautiful. So now is where we can ID our comps or put restrictions to find good comps. So the subsector, so I want the RBICS subsector for food and beverage production, or you could go even more for beverages production, or you could go even smaller into non-alcoholic, or you could do the GICS industry for beverages. Let's see which ones it spits out. That looks good to me. So this gets us the industry, this gets us the region, so I only want the target's country, and this sort of does the range. Now the good thing about the good thing about FactSet is that it will apply proper market cap ranges. So here it's showing 11 billion to 280 billion, right? So let's apply that. That is all good. And let's see what it spits out. So it comes up with 1, 2, 3, 4, 5, 6 comps. That's fine. So we're going to have 1, 2, 3, 4, 5, 6 comps. So what if I move over to the RBICS subsector? Will that give me a little bit more? Will that give me some more comps? I'm curious. And then we can 1, 2, 3, 4, 5, 6, 7. Okay, that gives me 7 comps. Let's look at beverages production. That gives me a few. So let's go to the GICS industry. You can be a little bit. You can be a little bit. You can make your own judgments. But Coca-Cola is mainly a beverage company, so that's totally fine. Now, where do we actually get this data from, right? So for comps, and it'll give you some comps tables, it's already giving us some valuation multiples here. Now, if you were in investment banking, you would calculate all of these. So you would calculate the firm's equity value. So you'd need their share price and their shares outstanding to calculate their equity value. And then you would fully build out how much net debt they have and what their diluted shares outstanding is, to calculate their enterprise value. And then you would go find their revenue, you'd go find their EBITDA, their EBIT, and their net income historically. And then you would go look at equity analyst research reports to find projected numbers for both of those, and then you can calculate your ratios. But we're just going to pull it from FactSet. So that is sort of where that depth and detail differs. But if there are differences between how an investment banker would do it and what numbers are showing up on FactSet, I am willing to bet that it's not super significant because FactSet is pretty good on their own. So what you can do is we can actually have FactSet build us a comps table. So if you go to custom, and here if you select plus, now you can create your own table and you can choose which metrics you want on here. So that's great. So I'm going to call this operating stats. So the first one I want is market cap, market value, I'm pretty sure it's called. So you can double click it to add it over here. So now it's showing ticker, company name, market value. So this is market value. So let me just make sure that this is the same. Yeah, so the market value is the same thing as market cap. One thing you should not do, and you can always edit it right here. One thing you should not do is you should not say equity value, because equity value for FactSet means the shareholders' equity. You'll see there's a big difference between market value and equity value right here. So you need the market value. You want their market cap, because equity value, if you click on it, well, it's talking about common equity and preferred stock, which you don't want. So equity value is not the right one. Even though we're calling it equity value, they should not say equity value. If I were FactSet, I would not call this equity value. I would call that shareholders' equity, which is very different. So market value, which is the market cap. The next thing you need is enterprise value. Enterprise value. So I can go and get their enterprise value. So that fills us up for these two. Now we need historical revenue and EBITDA, EBIT, and net income. So let's go and get that. So if we go to sales, I'm pretty sure they call it sales. So let's go and find sales, shall we? So income statement, sales, revenue, actual. I'll take that. Now, okay, let's go income statement, sales, revenue. So this is growth. I want FY, I want forward year. Income statement, sales, there we go, sales / revenue. So we have actual, which is historical. Now FY1 is what is projected for the current year, and then FY2 is what is projected for the year 2024. So that gets us our sales, historical, and then 2 years of projected. Now let's go to income statement, EBITDA. So let's get income statement EBITDA actual, which is 2022 EBITDA for year 1 and for year 2. And we can check that we got all of these, but so far it seems good. Now let's go to income statement EBIT. I bet it's probably going to show as both EBIT and EBITDA. Yeah, that's totally fine. So income statement EBIT, or operating income, let's get the actual. Let's get FY1, fiscal year 1, and then fiscal year 2. So we have our EBIT. And lastly, let's get net income. Net income for actual, forward year 1, and forward year 2. Great. So now let's save that, and I'm going to uncheck. So now look at this really nice operating stats table that they have built us out here with market caps and enterprise values. You have historical sales, historical EBITDA, and projected EBITDA. So for these numbers highlighted in blue, they will actually point you to where in the income statement you can find it. So they're making some adjustments to gain or loss on derivatives. That's totally fine. This shows you how they're calculating EBITDA. They're probably just taking EBIT and adding D&A, which is fine. And then these future ones, you can find these. They probably pull these from their estimates segment, and if you were doing it on your own, you could probably find equity research reports to find future sales or EBITDA or EBIT or net income. But that's fine. And now we have our whole comps table. So, oops, let's go back to comps. Good, it didn't delete it. So we have the selected financials table. I don't need this, so I'm going to uncheck it. Now, I will say, could you have gotten the ratios straight up because they also have EV to EBITDA? Yes, but we're being semantic, and it's only one extra step. We're just going to have to divide everything together, which is totally fine. So now we have our operating stats table. Let's download this. So I'm going to download, and I will open it. And I will do Command A to copy all of that. I'm going to go back to my Excel file, Alt-HIS, and then Control-V. Boom. And so now we have, I'm going to close out of that. Yeah, don't worry about it. It's all here. I'm going to rename this Comps Data, Alt-PVG, to get rid of the grid lines. So, and let's expand this out to see which companies we're working with. So Coca-Cola, Pepsi, Monster, Keurig, Constellation, Brown-Forman, and Molson Coors. Good comps. I'd say good comps. Okay. Already I'm beginning to notice some problems here because you have some negative numbers, which is fine. So, actually, you know what? I don't like Molson Coors. Let's because I don't want any negative numbers. That's the thing. You don't want negative numbers here. I think Molson Coors is an unprofitable company. So let's remove that, and let's add. So there were some companies over here. Let's see. General Mills or Mondelez. Is Mondelez up here? It is not up here. Let's add Mondelez. Mondelez International. Pretty sure it's Class A, but it's fine. Cool. And I have Mondelez. I don't know if I'd be able to move it up though, but that's fine. So let me download this now. This is why you should be careful with which comps you're using. So let's select all of that. Let's go over to the Excel, and now let's do Control A and Control V. It's fine. It's totally fine. So yeah, now we have Mondelez instead. There's no negative value, so that's good. Okay. Let's close out of that. Great. And what I'm going to do is, you can't just use these averages because these averages include Coca-Cola. For some reason, they insist on having Coca-Cola, or they insist on having your target as part of the comps, even though your target's not part of the comps. So what I'm going to do is I'm just going to highlight this. Let's make that orange. You also could have done that using Alt-H and then picking a color. But we should only be working with these values right here. So I'm going to go back to my Excel file, Alt-HIS, and then Control-V. Boom. And so now we have Mondelez instead. There's no negative value, so that's good. So And now what we can do is we can just link to these. So for our comps analysis, let us say equals for the actual comparable companies. Go up to our comps data and then select that. And then we will just go down to Mondelez, and that was our last one, right? Great. So now our equity value, so this is going to be reference the market value for Pepsi, and Alt HK to get that into comma format, Control R, because that will also get you the enterprise value, and then Control down, or Control D. So now we have equity values and enterprise values for each of them, and all of these are properly referenced, which is great. So now we can pretty much do the same thing. So LTM revenues, although, yeah, you could just move all of these over. So actually, I'm going to do that because it's nice. So there we go. So we have our whole list of comps data. So last 12 months of revenue. We're just making sure that they're all seeming right. 6331, 31,496. Yep. Let's just pick a random value. EBIT for Monster Beverage should be 15487. EBIT for Monster Beverage. Yep. There you go. Wow, copy and pasting works. Who knew? So now, once you have your operating statistics, now let's, well, here actually you can take a second to get the data for Coca-Cola. This is also kind of semantic. So I'm gonna highlight this in a different shade. And I'm gonna go and get Coca-Cola's numbers, because it's nice to have it on there. So their market value, and Control R, Alt HK to get that into comma format, and there you go. Now we have some. Actually, over here I'm going to do Alt HAN, so that's an accounting format, and then the rest of it can be Alt HK. This can also, I guess, be in yeah, I'll make that accounting format. No problem. Okay, so now what we can do is we can copy this header. Oh boy, not that much. Let's copy this header. And now we can actually create valuation ratios. So valuation statistics. So for our capitalization, this can stay the same, and this can just be, these can be the exact same. So Control R, Control down one more, make these Alt HK, this Alt HAN. Could have done that later though. And here's where we can actually calculate our ratios. So for revenue, we're going to calculate enterprise value. So enterprise value to revenue, and let's center that to make it look nice. This will be enterprise value to EBITDA. So I'm just going to copy that, and enterprise value to EBIT. And then here, we're going to calculate price to earnings. Price to earnings. There we go. So now, how do you calculate EV to revenue? Well, you can say equals, go to this EV, and instead of locking it, well, you can lock it. What you should do is you should lock the column. So F4, F4, F4. Make sure the $ is in front of the column D, so that now when you divide by enterprise value to LTM revenue, that will get you to its EV to LTM revenue. And now when you go across, it's still dividing by enterprise value. So let me quickly do, so here for ratios, you want the X format. So if you don't have shortcuts, honestly, you don't need to. You can just have them without X formats. But if you want it to be nice, you're going to go to Control 1, Control left to get into the number, go down to Custom, and then over here, instead of general, you can just say 0.0x. There you go. So that is what I can do. So oops. My shortcuts are going crazy. So yeah, so you can just go to Control 1 and then say 0.0x to get into this nice X format, because these are multiples. So it's just saying 3.3 times whatever, right? So yeah, again, go here, lock the column, and then you can divide it by LTM revenue. Go over here, and then get that into the X format. I like 2 decimal places, but that's fine. And now, because you locked the column and not the entire cell, you can also go down. So you'll notice that EV to EBITDA for Pepsi is their enterprise value divided by their LTM EBITDA, which is true. But now we can also copy down. So forward year, fiscal year 24, EV to revenue for Keurig Dr. Pepper is its enterprise value divided by its fiscal year 24 projected revenue. And price to earnings, you should not do it for price to earnings, my bad. This should only be done for the enterprise value ratios, right? And then for EV to EBIT, let's just check this one. It is Brown-Forman's enterprise value divided by their fiscal year 23 projected EBIT. Now for price to earnings, reference to their equity value, again, lock on the column and then divide by its net income. So LTM net income, Control R, and then Control down. So make sure that these are all, whoa, that is a big ratio for Constellation. That might cause some problems in the future, but that's fine. Okay, so now we have done this, and calculated valuation ratios. Now we can actually pull a range of ratios to apply to the target. So which ones are those going to be? So we need the minimum, we need the 25th percentile, we need the median, then the 75th percentile, and the maximum. So we're going to pull 5, so one of these is going to be left out, which is fine. Usually you have more, so that helps. Alt HBS to apply a border. Actually, I'm going to make that a thick border. Let's make that a thick border. So Alt HBT instead. That's a little bit nicer of a border. Alt HBT. Oh, oops. Alt HBN for this part, and then, oh boy, fine. I will just do this all over again. So bring it all the way here, Alt HBT. There we go. Okay. And now what I'm going to do is I'm going to put some X's here because I don't want to have to keep copying all the way down here. So now I can easily get here without constantly having to go all the way to column XFD. And then the median is going to be really important. So this one I'm going to highlight. Let's highlight that and then bold it. All right, so minimum equity value. So we're going to use one function for this, and the function is called percentile.inc. So this is going to return the kth percentile of any value in a range, where k is a range of 0 to 1. So for this range, we can, for the equity values, we can pull its 0th percentile to get its minimum. And of course that gives us 3213, Alt HK, to get that into comma format. And then we need to do the exact same for this. So the 25th percentile is going to be percentile.inc, select this range, comma 0.25. That gets us the 25th percentile, Alt HK. Don't worry, you don't have to do this whole step for all of them. The median is going to be percentile.inc, select the equity value range, 0.5, Alt HK. The 75th percentile, pretty simple, same stuff, grab the range, oops, percentile.inc, grab the range, 0.75, and then the max equals percentile.inc, go over here, and then say 1. That'll grab you the max HK. And I suppose we can make this the Alt HAN format. And now you can go over here and you can do Control R. So let's go ahead and do Control R. There you go. So actually, wait. So sorry. This should not be in. These should be in the X format. Nice X format. There you go. And let us grab this and do Alt HBT again to get the borders. Or you could just do the borders after. So let's just make sure that this is calculating the right ratios. So it is taken, and it is the 25th percentile. This is taking the median, which is good. This is taking the 75th, which is good. So when you do a range like this, oh man, I already know that this PE ratio is going to be absurd. Which is fun. That's totally fine. But most of the other ratios are in a somewhat reasonable range, as you can tell. So yeah, just making sure that all of these ratios are pulling from the correct ranges. You don't want any incorrect ranges. And you'll notice that this is all pretty simple because this whole process, there's a lot of cells on here, but it really is just copy and paste work, which is not bad. So again, for Coca-Cola, grab their equity and enterprise values. And then for this, you can just lock this. So this is going to be F4, and then divide that by its revenue. And you can do 1, 2, 3, 4, 5, 6, 7, 8, 9, Control R, change that into the X format, the multiples format. And then for these last ones, take their equity value, lock that, and then divide it by their net income. This is why you calculated. This is why we brought Coca-Cola's financials into it too. So now you can calculate Coca-Cola's ratios, and if you wanted to do a simple comps analysis, you would stop right here pretty much, and you would compare these ratios to sort of the industry average ratios or the ratios of these companies, and you would say, hey, look, for example, Coca-Cola right now is at 22.4. The median is 22.18, and the average, I'm not sure what the average is, but it might be, let's say it's like 20, I don't know, it's probably 30. So let's say it's 23. Coca-Cola seems undervalued based on projected price to earnings. And right now it's 28. This is, the median is 38. The average is going to be a lot higher because Constellation is bringing it up a lot. So it might be undervalued. But then, you could look at, say, this one right here based on, or you could look at this and you could say based on EV to EBITDA, it's trading at higher than the median, so it might be overvalued. So you would stop right here if you wanted to do the simple version. But let's go for it. Let's go for the full version. So now what we can do, so now that we've actually pulled evaluation range of ratios, now we actually apply the relevant metrics to those ratios. So I'm going to pull this header again, and I'm actually going to delete most of this. So I'm just going to pull this part then. Valuation statistics. I'm only going to need this part, and then let's add another row, and I'm going to call this valuation multiples. Let's see what I called it. Actually, let me take a break. Let me go get some water, and then we will go and actually apply these ratios. Okay, let us resume. So valuation summary, this is the table that we need to create here. And here is where we will actually apply our ratios. So what are the ratios? So this is going to be the min, this is going to be the 25th, this is going to be the median, this is going to be the 75th, and this is going to be the max. Multiple. And here we can extend Control C to Alt EST to get that header going. Let's leave some space, and then here we will say applicable company figure, or applicable target figure, and then we will go ahead here and then Alt EST 20. And then here we will actually calculate the ratios. So this is just Coca-Cola range of valuation ratios. So take that, Control Shift M, UU, zone and min, 25th median, 75th max. I'll format that in a second, don't worry. Control, let's on, and then here is where we'll actually calculate the implied share prices. So we're gonna need that. Min, 25th median, 75th max of the implied share prices. So let us do Control R to get that over. And then we can copy this header. Control C, Control V, and this is range of implied share prices. Let's format this a little bit better. So this is going to be the minimum price. This is going to be, or I can just say, so actually, sorry, minimum, right? This is going to be 25th percentile. This is the median, 75th, and then percentile, and then maximum. And let's center these. Does that look nice? That looks nice, I think. Okay, great. Actually, let's bring these headers down. Oh boy. Oh man, oh man, oh man. Control C, Control V, and then delete this. There we go. Then Control C, Control V, and then delete this cell. Great. So now, instead of comparable companies, we're going to say methodology name. So for public comparable companies, which ratios are we going to? Well, we're going to be using all of them, so it doesn't really matter. Okay, so what do we need? Well, we need LTM EV to EBITDA, LTM EV to EBITDA, then fiscal year 23 EV to EBITDA. Actually, I'm going to put a space between here so that it's a little bit easier to read. LTM, and then fiscal year 24 EV to EBITDA. Sorry, I've been saying EBITDA. I meant revenue. So that's the first one. Actually, I'm going to have to type EBITDA anyway. Bit of a mistake. This is probably the most tedious part, where you're just going to see me do a bunch of repeated stuff over here. Boom, oops, boom, and then boom. So here we can call it EV to EBITDA. Actually, what I'm going to do right here is I'm going to say over here, Alt-H FDR. Can you do find and replace and say replace revenue with EBITDA, and then it can replace and then replace. So now we have EBIT EBITDA, and then over here Alt-H FDR, replace revenue with EBIT. So replace. There we go. And then here we're going to say LTM price to earnings. And then fiscal year 23 price to earnings, or PE. You can also type PE, it doesn't really matter. And then fiscal year 24 price to earnings. Now, this is going to be our comps analysis, but we also did a DCF valuation. So let's put our DCF valuation here. Actually, I'll wait to do that, but I'm just going to bold this, and that's going to remind me to put in our range of DCF valuations. So here's where we actually can get our multiples. Okay, so what were So instead of just doing this the entire day, spending the rest of the day on doing direct cell references, what we can do is for our LTM EV to revenue, we can copy that and then do Alt E S, and then instead of V like I normally do, you can do U to get the values and number formats. Alt E S U. Boom, that'll get us the values and number formats. Actually, let's copy that and then paste that here. And copy that again, so Control C this and then do Alt ESE to transpose it horizontally. So we had it vertical, now it's horizontal. And that looks a lot nicer. Now don't worry, you don't need to do that for every single ratio here. So what you can do is you can grab multiple columns. So Control C, bring it here, Alt ESU, and then this is your EV2 revenue, so Alt ESE, and then this is your fiscal year 24 EV2 revenue, Alt ESE, and then just make sure that these numbers match up. So yeah, this was our 3.2127.85 was fiscal year 23, sorry, and then 3.07 to 7.38 was our fiscal year 24. So I recommend doing these 4 in chunks at a time so that you can get your a whole ratio done. So I'm not going to do all of this at the same time, but I will do it in 3s, which does save a little bit of time. So I'm going to bring that down here, Alt ESU to copy formats and numbers. Alt ESE, Control C, Alt ESE. I'm wondering if you can also transpose together. Alt ESE. I'll do that for the next one. So just to make sure, just check. So this is EV to EBITDA. LTM is 15.07 to 31.5. 23 is 14.52 to 25.34, and then 13.33 to 22.6 is fiscal year 24. Great. So now let's do EV to EBIT. Copy that, bring that here, Alt ESU, and let's see if we can transpose it all at the same time. Alt ESE. Seems like it did it. So Command get rid of that. So EV to EBIT was this one. So let's zoom out a little bit so that we can see. So 17.29 to 32.86, yup. 16.67 to 27.53, yup. And then 15.15 to 24.25, yup. All looking good. So we can actually transpose and group multiple at the same time, which is great. Alt ESU, Control C, Alt ESE. Now the reason that we're doing this sideways valuation is that, well, we were initially given vertical values and now we have to make it sideways because it'll be a little bit easier to see, and then we can just copy sideways. So I'm going to do this last check real quick. So yeah, 28.32 to 408.69, 19.34 to 36.08, and then 17.18 to 30.9. Great. So now our target applicable figure. So this is going to be Coca-Cola's applicable Coca-Cola figure. So our revenue, or our historical revenue in this case, actually what we could do is we can transpose this. So what was Coca-Cola's LTM revenue? Well, it was this, right? So literally what we can do is we can just copy this over, Alt ESU, and then transpose it here. Alt ESE, there. So this is giving us all of Coca-Cola's, let's just do Alt HK there. So this is giving us Coca-Cola's LTM revenue, fiscal year 23 revenue, fiscal year 24 projected. These are all projections, by the way. And now what we can do is we can multiply these. So before I do that, let me go up here. Let me insert some rows so that I can get two very important pieces of information. The first we need is Coca-Cola or KO's net debt. So KO net debt and KO's shares outstanding. So we can go and get their net debt figure from our DCF model. We got that right here, 29 Alt HK, boom. And then their shares outstanding, we can go and get that. And then we can divide that by 1,000,000 to get that into millions. Alt HK, please. There you go. So we'll say that that is in millions already. So the reason that we need net debt and shares outstanding is that, well, when we multiply these revenue numbers by these enterprise value ratios, we're going to be calculating enterprise value. So from that multiplied number, we need to subtract net debt to get it into an equity value. And then for all of the ratios, we need to divide by shares outstanding to get into an implied share price. So let's do that. So for the EV revenues, so for the EV multiples, open two parentheses, take your multiple. And this multiple, again, if you want to be able to hold it across but be able to move it down, you lock the column. So F4, 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 so the dollar sign is in front of the I, and then move it over. So this is going to get our minimum enterprise value. From this, we can subtract net debt, and this we can straight up lock, C23. So now, so when we multiply Coca-Cola's LTM revenue by the minimum LTM EV to revenue, that'll give us EV. We're subtracting net debt to get an implied equity value, and then we'll divide that by our shares outstanding in millions, only lock that, and that'll get us to an implied share price. Let's do Alt HAN, get that into accounting format, and let's copy and cross and see what happens. Are we making any mistakes here? So this is multiplying this revenue by the 25th percentile and then dividing by appropriately. Boom, boom, boom. There we go. Now let's do the exact same, but we can actually just do Control D to get it all down. So just make sure that this is multiplying and dividing by our proper cell references. So all of the minimums are good. If I was at a job, I would make sure I would check all of these numbers, but I'm just gonna check random ones. So yeah, 75th percentile for LTM EV to EBIT, taking the EBIT and then the LTM number, and then dividing it, subtracting net debt. Oh, okay, sorry. So for these last two, the equation is a little bit different. So all we need to do is, we don't need to subtract net debt here. We just need to multiply net income by equity value, because that's already net income by the ratio, the PE ratio, because that's already going to get us into an equity value, right? So let's do that, and then Control R and then Control down. So yeah, like 900. I don't think that that's a very reasonable estimate. So I don't like this ratio. So what I would do is I would probably throw out this whole ratio, something that looks completely absurd. This is the only number because Constellation is apparently extremely overvalued right now compared to its earnings. This is the only one that just would not fit on the graph. So you know what I'm going to do? I'm just going to delete it. So what we're left with is a much more reasonable range of values. So we're just going to get rid of LTM. We're going to get rid of LTM price to earnings. Okay, so make sure that all of these numbers are good. Yep. Do not subtract net debt from equity value. That is not going to be good. And now we can go to our DCF valuation. So this is just a summary. So this is giving us a range of possible share prices. Actually, over here, let's make this. Oops. Let's get this into Alt HK formatting. Boom. So that it looks a little bit nicer. And then here's where we can put in our range of values for our DCF. So we already kind of did this for when we did sensitivity analysis. Here's where we can actually get it into a table, and then all of this data will be going into a graph, right? Okay, so the way that we can name this is we can call it our WACC versus our long-term growth rate. So this was a 3.74% WACC to 7.74% WACC. So 3.74% to 7.74% WACC. And then what was our range of growth rates? 1.3 to 1.7%. 1.3% to 1.7% terminal free cash flow growth rate. And we can use all of this space because there's no ratios here, and we'll just put in the prices right here. Okay, so this is going to be equal to, we can use our percentile.inc function, and then we can copy this data, or we can get this range. Make sure you F4 that so that you lock that range, and then it is 0 is going to give us the minimum, so that's going to give us 34. So we want Alt-HAN over here. And if you range, look, it's only going to have zeros, but here's where we can make it 0.25 to get that into the 25th percentile, 0.5 to get the median, 0.75 to get the 75th percentile, and 1 to get the max. So the max is 120 right now, which is a little bit much, but that's fine. And we can do the same for our other sensitivity table. So the other sensitivity table was 3.74% to 7.74% WACC. But the other sensitivity was against our exit multiple, so 17.98 to 21.98. And we also use a different comp set, so this is not totally accurate. There's not a perfect DCF valuation by any means, but that's totally fine. EV, we'll just say exit multiple. Great. So let's do the exact same, except over here we're going to change up this range. So we need to change the array. So let's go to our DCF model. Let's get these range of values. Let's lock that H77 to L81, and then bring that over to the right. Oops, that's fine. So let's make this 0.25. Let's make this 0.5. Let's make this 0.75 and 1. There you go. So now we have a range. So 50.74 and 73.76. That's pretty reasonable. So this is the only one that's a little bit of an outlier. So what I would probably do is I would probably tighten up these growth rates a little bit. So let's see if maybe if I do like 1.65, it's probably not going to help because this is all well above the range. Actually, it's a very striking jump. You know, you're in the 70s, and maybe it's the WACC that needs tightening, but that's fine. That's totally fine. It's all going to look fine on the graph anyway. So now what I can do is we are going to create a graph. So now we have all of this data. Let's create a graph. Let's create a nice looking football field chart. So the methodology name, so here it is going to be called range of implied share prices. Actually, we have a range of implied share prices here. This is just our graph data. Graph data. And this is going to look a little bit weird, but just trust the process. So first we have public comps. Public comparable. I'll just say public comps. That's fine. Okay. So now we actually need to get these. We need to get these ratios. So I'm going to do it in a weird way. So for whatever reason, when you insert a chart, it shows the data opposite. I have absolutely no idea why. So trust the process. Okay, just trust the process. So the first thing we want to show is we want to show EV to revenue, right? So I'm going to say forward year 24 EV to revenue. And then I'm going to grab this. Actually, I wonder if I can just transpose that. Alt-E, S-E. Actually, wait, no, that's actually going to transpose it horizontally, isn't it? Yeah, don't do that. So I'm going to grab EV to revenue, 23 EV to revenue, and then LTM EV to revenue. So that now this shows at the bottom. Actually, wait, no, I want, so the ones that show at the bottom will actually show at the top. So EV to revenue needs to be last, and I want price to earnings to be at the top. Sorry. Okay, so let's get forward year 24 price to earnings, forward year 23 price to earnings. I wish there was an easier way to just like reverse the order here. So now let's get EV to EBIT, or let's put that right there, move that up there, LTM, and then forward year 23. This is a little bit tedious, so if you want to skip this part until I'm done, no problem whatsoever. Oh. That up there. Oh. There we go. Forward year 24, fiscal year 24, fiscal year 23, EV to EBITDA, EV to EBIT. It's good. And then let's get our last ones right here. It's a little bit tedious. It's totally fine. There we go. So now we have them showing in reverse order. I hate that, but that's totally fine. And then we have our DCF valuation. So we're going to leave a space, and we are going to grab these two. And of these, I don't really care which one shows up first, so let's just put it all down. Let's just put it all down. Boom. Okay. Actually, over here, I'm going to move this over. And then we're going to leave some space right here. There we go. Okay. So this is going to be our valuation comp. So actually, we already have the methodology name down there. Okay, great. So we want to leave a little bit of space up here, and then a little bit of space up here, and I'll show you why in a second. Then we're going to need our chart title. And this is going to be where we can put our chart title. So this is going to be Coca-Cola range of implied share prices, and here is where the magic happens. So okay, so now we actually, so the first thing that we need to do is we need to go and get our prices, but now this is in reverse order, right? Because we had to reverse the titles, because that's how our graph is going to look better now. So now let's just go and get these prices. So I'm going to say this is our range of share prices. Boom. So the way that we can get our range of share prices is we can use the lookup, the XLOOKUP function. So this is one of the most powerful functions that you'll use if you ever use Excel. So lock the column on the cell reference. So this is the lookup value, comma. This is our lookup array. So look this array up, comma, and then go get the minimum share price, and then lock that. Boom. And it is returning the right one. So 46.08, and this should all just be a reverse order. So 48, 50, 42, 43, 41, 41. Yeah, so this is in proper reverse order. And now we need to go and we cannot just copy over, because this is it's the same lookup array, right? But we actually want the 25th percentile, so we can just say make that M and M, please. So get that down. So now it is showing. So Sorry, that's getting the third one. Make that L. L, please. And L. Yep. So now we just have our prices in reverse order. So 53, 52, 48, 47.9, 56, all good. Now is our median. Now we can go get M. M, please. Control down. Now is N. LMN. Control D for down, and then our maximum, so O. O62 to O72, please. So now we have our prices just listed in reverse order, which is great. Just make sure that, 48, so on and so forth. And I am going to, so we can, oops. So here's actually where we can build out our graph data. And then Control R, get this over here, and then this is our graph data. Data points for chart. Say that. Okay, so what we're gonna need is we're gonna need our minimums, and then we're going to need the 25th percentile price minus this price, or minus the previous, minus the minimum price, so on and so forth. So now this is the 25th percentile to the minimum, then it's the median to the 25th percentile, then it's the 75th to the median, then it's the maximum to the 75th. And why we're doing this is we want to be able to build a stacking chart to show how the prices evolve, how the prices increase over the different percentiles of the share prices. Sorry. If that doesn't make any sense, don't worry. Just trust the process and it'll all look beautiful in a second. So make sure that all of the minimums are just the minimum prices, and then everything after is the difference between those two. We can do the same. So our terminal FCF growth rate over here is just going to be the same. So Control R, and then this is our prices. Control R, Alt HN, that's fine. Or sorry, Alt HK, please. And then we can do the same here. So copy this formatting, Alt ESF, and then Alt HK, and then Control C, Control V. So, yep, this is getting our values, and it is properly subtracting one from the other. It's good. Let's keep doing F2 to check. Great. So now we can actually build a football field graph. So go to Insert. Oh man. So if for whatever reason this is not showing, go to Options FT. That will go to Advanced. Excel Options, Advanced, go down. I hate it when it does this. And then Display Options for this workbook for Objects Show All. I have no idea why it does that, but that's fine. So I am going to start a 2D stacked bar chart, please. So a 2D stacked bar. That's what we need. So I'm going to bring it down here, and we can just edit it right here. And let's really give it some space, because this is going to be a big behemoth graph. So let's go to Select Data. So you can right click on it, Select Data, and then in Chart Data Range, go and select our values over here, and then select, and then include spaces in between your comps and one below your FCF growth rate. Boom. And then say OK. And now look at what it spits out. So just give it a second. I'm not sure what's going on here, but maybe the graph needs to recalculate or something. Come on. Yeah, so now my computer's starting to lag a little bit because of the size of this graph. What if I delete this? So select all of this data, go one down, and then go to Insert Chart. There you go, 2D stacked chart. Is it still showing? I hope it is. I hope it's showing all of them, but this looks a little bit ugly right now, but no problem. No harm, no foul. Okay. Yeah, I think it's good. So now let us format our titles. So let's go to select data, and let's go to edit horizontal category axis labels, and then grab these labels, and then grab that space at the end there too. Oops, I don't know why it does that. Sometimes it just wants to complain. Okay, cool. And now look at that. Now for each valuation multiple, it's showing the prices. Well, and it's showing the different price levels that it's reaching at different percentiles, right? Okay. So let's clean this up a little bit. First, let's add a chart title. So you can actually just click on the chart title, say equals, and then put it to this cell. So if you change this cell now, that's going to change the chart title. So that's nice. I like to reference my chart titles to a cell. Let's select this horizontal axis. Let's let us edit format axis. Let's go over to number, scroll down, make that a currency, and also go to format and then make the text black so that we can see. We'll do the same here, make that text black, make it a little bit easier to see. Same for this, make the title black so that it's a little bit easier to see. Now we can make it fancy. So what we want to show is we want to show a range of values, and that range that we want to show is the range between the 25th and the 75th percentile. That's commonly how football field graphs are shown. It's between the 25th and 75th percentiles. So what is the 25th? Well, this blue bar gets us up to from 0 to the minimum. So we don't want to show that. So what you can do is click on, so you can just click on one of these blue bars, right click, go to format data series, and this is our series 1. Go to series options and then go up here to fill in line, fill, and say no fill. And that, it still keeps it, but it's just making them no fill. Now this orange series is getting from the minimum to the 25th percentile. So the bottom of the gray bar, the most left part of the gray bar, that is actually the 25th percentile, and that's what we want to show as the minimum. So we don't need the orange bar either. So make that no fill. And so this gray bar is showing from 25th to median, and then the yellow is showing from median to the 75th. So that's good, which means we don't need this last piece of 75th to max either, because this will usually overinflate the range. So let's do no fill. Good. And look at that. Look at that. Actually, over here we removed price to earnings, didn't we? We shouldn't have done that. We should have kept price to earnings. So over here, I'm just going to insert a row, and I'm going to say LTM price to earnings. And we removed it because, well, we removed it because it was way too high for the max, but this is not even going to show up on the graph, so it's okay. So let's copy that. I'm just gonna paste it, oops, Alt ESU, and then Control C, and then Alt ESE. Wait, sorry, it's not here. My bad. Okay. So over here, we can get our LTM price to earnings. So that's a very important metric. We still want to show that. So my bad for not showing that before. So yeah, here's where you actually get the range of share prices. So I'm going to just Alt ESU, paste that in a random location, Control C, and then Alt ESE to transpose that. Boom, 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 get rid of that. And then you can use this formula to calculate the ranges. Actually, I don't know why that's not working. Oh yeah, because we need the applicable Coca-Cola figure. So this is equal to their LTM net income. So let's get that. Boom. So this is going to show like an absolutely ridiculous number, but that's okay. Because the minimum and the maximum won't even be shown. So it'll only show these three. So that's good. So here for, we're actually going to also be able to show LTM price to earnings. LTM price to earnings, and we can just copy these values right here. So the range of implied share prices is, make sure that is 271. Yep. Control R, and then copy and paste this. So boom, 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 and then 800 to the max is totally fine. And I'm pretty sure, yeah. So now this is dwarfing because the last data series, oops. Yeah, the last data series is completely dwarfing our, it's dwarfing the numbers. But luckily we can get this back into reasonable territory if we adjust this. So let's go to the format axis, and let's just say make it 100, please. And what now? Yeah. So now it's showing from 0 to 100. So this looks a lot nicer. So now let's make the colors look a little bit nicer. These are not really complementary colors. So let's go to Format Data Series. Let's make this a dark blue of some kind. And let's make this a, let's make this data series like a light blue. Nice. There you go. So now that looks a little bit nicer. And now look at what we have. So the LTM EV to revenue. So the reason that we had to reverse these is that I want to show LTM, then fiscal year 23, then fiscal year 24. But if you hadn't done that, then it would have shown fiscal year 24, then fiscal year 23, then LTM. And I want to show it in order of the way that we had initially presented them. Because we initially pulled the values in this order: revenue, then EBITDA, then EBIT, then net income, and then LTM 23 and then 24. So I wanted to show it based on that too. Okay, so now let's format this a little bit better. So let's go to chart design. Let's go to add chart element, and then the legend, I want it on the right instead. I don't want it on the I don't want it at the bottom. So now we can actually, so series 1, 2, and 5 are not even being shown. So we can go to select data. So for series 3 and 4, this is what we actually care about. So let's edit series 4 and let's call it 25th to median. Let's edit our series 4, call it median to 75th. Okay. And in order to get rid of these, we can actually just double click. So double click so that that gets on series 1 and then just delete it. So click on series 2, get rid of it. Click on series 5 to get rid of it. And now the legend is only showing 25th to median and the median to the 75th, which is good. Okay. Now, how do we add our current stock price? What usually happens is there's a current share price shown in the middle of the football field to show, okay, so we have the ranges, but where is Coca-Cola actually trading right now, right? So we can, let me add some rows here. Boom, boom. So current share price. And we can go, so this is going to be equal to, let's go to our DCF model. Let's reference the current share price. Let's see if the share price has changed actually. Now's a great time to check if the share price has changed. So it's 62.58, not 62.48. So, or 62.84. So 62.58 is the current share price. And we're going to set this equal to this. So this is how we actually build that out. And then we need some kind of dummy value. So 1,000 and then 0, 0, 0, 0. So put some value here, 1,000, and then just zeros right here. And and I'll show you why we're doing that in a second. So now, in order to add this horizontal or this vertical bar, what we can do is we can go to chart area, we can select data, we can add, the series name is going to be the current share price, and then the series values are going to be this range of the current share prices right here. And then say OK, and then say OK. Now this is going to look messy, don't worry, that's supposed to be the point, so let's clean this up a little bit. So let's click on it, and what you'll notice is when you click on it, up here in the cells, it has B100 for the name, and then it's only showing the X values, but we also want to show the Y values. So get rid of this comma right here. So now it's B100. So initially it was showing right here, right? So now there's just a space here. So get rid of that. So now our 62.58 becomes our X values, and now we want to add a comma, and then right here we want to select this range. So K100, 101 to 101, and then instead of 6 we only want 1. So only show the first one. Boom. Now that is also going to mess it up, but don't worry. So next what we can do is we can click on it. We can go to right click on it and then go to change series chart type, and then instead of making this a stacked bar, let's make this a stacked line or a scatter. So scroll down and make this a scatter with smooth lines that automatically selects the secondary axis. So now we have a vertical bar, which is good, but it kind of messed up our data labels over here. So let's do that. Let's fix those. So right click on the chart, go to select data, and then for series 1, let's edit the horizontal category axis labels. Select our labels again. You might have to do this. Yeah, I don't know why it makes you do it 2 times, but do it 2 times if it asks you to. Great. And now we have our labels again, but now this bar isn't going, it's not going the full distance because there's now a horizontal axis here. So what you can do is you can go back to chart design. Actually, let's select the horizontal axis. So let's go to format chart area. Let's go to chart options and then the secondary vertical value axis. So now this is selected. Go to axis options and then make the minimum 0 and then the maximum whatever dummy value you set. So here we said it was 1,000, so let's make it 1,000. So now it's showing, boom, now it's showing fully across. Great. And let's change the color of this so that it's a little bit easier. So this is a line now, so let's make that red. And that looks a little bit nicer. Great. Now, let's clean this up a little bit. So we can actually get rid of this. So let's go to our axes and let us deselect the secondary vertical axis. So only this is showing. And now let's put in some data labels. So let's go to insert. So we want to show that these are DCFs and these are public comps. There's no really easy way to do this. Also, what I'm going to do is I'm going to move this chart over here and I'm going to stretch it out a little bit. There you go, so that it looks a little bit cleaner. And then here I'm going to add in a text box because there's no really easy way to do this. And I'm going to say DCF valuation. And I'm going to decrease the size of that if possible. And boom. Oops. So DCF valuation. So right now it has a fill and it has a border. I don't want either of those. So I'm going to go to shape format. Shape outline is no outline. Shape fill is no fill. Good. And then I'm going to make the text color some kind of blue. There we go. Let's bold that. DCF valuation. So it shows that these two these the WACC versus the exit multiple and the WACC versus the terminal growth rates are DCF valuation. And then let's copy that and then paste that. And here we have our public comps. Boom. And now we have a graph, and this share price is dynamic. So if for whatever reason the share price went up to, let's say, 70, now the graph, the red line moves. And if it goes up to 80, the red line moves. Let's not do that. And if it goes down to 30, now the red line is below. But let's set it at its actual price. So this is a good looking graph. And what does this actually tell you? So this tells you what is Coca-Cola currently trading at. That's the red line. And then all of these ranges show, within a reasonable estimate, what should, based on our DCF analysis and based on our public comps analysis, what is a possible range of values for Coca-Cola. And for some of these, it seems like it's undervalued. Some of it seems like it's overvalued. So maybe it's just maybe it's just trading around the range that it is. If you get most of your values being stuck like right over here, that might tell you that the company is overvalued. If the company's share price is, if your range is mostly over here, or if the median of your range is mostly over here, that might give you some reason to tell you that it is undervalued and that you should buy. But right now, I can't really tell you to hold this stock. Maybe it's slightly overvalued because for EV to EBITDA and EV to revenue, which are probably the most important ones, and even for the exit multiple, it is slightly overvalued. But which makes sense because all of these are sort of based on enterprise values, and Coca-Cola is a massive company, but why the PE ratio shows that it might be undervalued. But this is sort of what you can look like. So this is just a method. Obviously, this is your takeaway from this graph is entirely going to depend upon what values you have, what your DCF valuation looked like, and the comp set, the quality of the comp set. I don't think our comp set was super great. We only got 6 comps. I wish we had more, but FactSet was pretty limited in which comps it wanted to add, but that's okay. That's totally fine. But this is sort of the graph that you can expect to get, and I think that this is a really nice looking chart. So if you did this full comps analysis, if you did it fully front to back, this is the graph that I want to see. I want to see this football field chart, and you don't have to show any of this. You don't have to show any of this, all of this work. This looks really messy. But the graph is the important part. So take a screenshot of this and put this in your slide deck. And I think this is a really clean way to present it. So other than that, that really does it. This is the last video in the series on how to do a corporate valuation for a public company. We covered DCFs, we covered a full DCF model, building out the free cash flow schedule, finding terminal value, calculating WACC, calculating implied share prices, using intrinsic valuation, and then doing sensitivity analysis on that. And we also pulled comps and did a full comps analysis. And we calculated a range of values using comps, and we used our sensitivity analysis to get a range of values for a DCF, and then it all culminates in this chart. So we asked in class, or we asked during our lectures, what is the final purpose of any valuation? Technically, the right answer is an enterprise value or an equity value. For finance, that answer is a share price, and for the purpose of this specific workbook, it is this graph. That is what we want to see. So I hope you enjoyed this video. Please let me or Akash know if you have any questions, and I will be signing off from here. You have a wonderful day. Take care.